luxury sector long term, it's probably one of the most attractive places to be in the consumer sector. Typically a GDP multiplier, high barriers to entry, very strong balance sheets. One of the few sectors where being made in Europe is actually a positive. High margins, I could go on and on and on. But clearly, you don't want to be buying these stocks necessarily chasing towards the upside. It's actually when they come back 20, 30%, which we've seen currently, they actually start to look much more interesting.
It was somewhat surprising to see some of these analyst downgrades come through once the stocks had already moved a great deal off 20, 30% from where we were just over a month or so ago. But what do you make of the arguments that the U.S. aspirational consumer is showing signs of weakening? You've got concerns about China growth still. And then on top of that, some of the bears are saying that Europe is beginning to crack, that the reduced inflow of tourists from China and a weakening domestic consumer are putting pressure on Europe. I mean, those are some pretty compelling headwinds.
Yeah, but I think you have to take it on a relative basis. The way the stocks are acting is like maybe we're heading into a 2008-9 type situation. Now, from our discussions with the luxury companies, most of them are saying, look, this is more a period of normalization. We obviously had 20, 30, 40% growth in that post-COVID period. Maybe that some of that was excess savings being used, et cetera, et cetera. Interestingly, the U.S. Federal Reserve still saying the top 20% in the U.S. do have excess savings left over. Now we're seeing more of a normalization. So that's more likely to be mid-single digit, potentially high single digit growth in the current quarter. And then if you start to look into calendar Q4, the comparable gets very easy in China. Remember, China was locked down last year, and obviously that has been weaker than overall expected. So it's not like the sky is falling in. I think that's the message. And basically, the time to look at these companies, time to pick them up, of course, is when they're under pressure. It's not to try and chase them higher, as many of my colleagues seem to be doing in Q1, Q2, when they'd already made outstanding gains over the last 12, 18 months or so.
Interesting what you say about sort of chasing the price action there. I do wonder whether, in your view, you think the luxury sector is a cyclical sector, because again, looking at all of the other notes from your peer group and going back to something that you said at the beginning of this interview, the fundamentals seem to be pretty secular and specific to luxury. There's brand desirability, strong profitability, high barriers to entry, solid management, strong free cash flow generation. All of those are very specific to the luxury sector. But to what extent is it behaving like a cyclical asset class?
I think it's one of these sort of sell-side broker ideas every now and then that actually luxury is not cyclical. In the same way, 10 years ago, people were saying, oh, luxury, people are not interested in luxury anymore. People want to, take holidays instead. As always, I think you need to look at the middle ground. Yes, there is bound to be some cyclicality in anything where it's a discretionary spend. You're choosing to go out and buy something. You don't need to eat diamonds and gold or watches for dinner. You need to go out and buy food products for dinner. So there's bound to be some cyclicality. But if you look over the medium term, typically incomes are rising. These are GDP multipliers. And overall, I'm confident the sector will come good again. Of course, you get periods of volatility. Yes, there will be a slowdown. We're seeing that now, but the sky is not falling in. Looking ahead to Q4, as I said, the comparables are pretty easy. Into next year, the US and China will probably be slightly more stronger than we are now. Maybe that interest rate cycle is coming towards a peak. It's certainly not a 2008-9 situation. I don't think there's any reason to panic. If the stocks have already moved down and you're a holder of these stocks, I would say keep hold of them. Of course, if you're not in these stocks, maybe it's the sector to avoid in the next couple of weeks.
Interesting. What about the medium term? You talk about the GDP multiplier effect. And again, we spend a lot of time looking at the state of the Chinese macroeconomy, and many analysts come on the show and they say that looking ahead, Chinese growth is expected to moderate in the coming years. There are a lot of, again, structural issues there. You've got high youth unemployment, you've got aging demographics, you've got super high levels of debt. So all of those things over the medium term don't necessarily bode well for income generation and therefore for the luxury sector. What's your view?
I think there's segments of growth all over the world, and I think you just have to look. India at the moment, obviously its population now is close to China. Ethos, it's a Rolex retailer, for example, in India, just exploding in demand. So you have other countries that can come up and maybe pick up some of the slack. Of course, the Chinese economy is going to decelerate, but the growth is certainly still going to be better than the developed world. And that's why I tend to still be quite positive on the outlook for China long term. And don't forget the travelers. A lot of focus on mainland China and maybe how that's not going so well. But look at the data points coming out of Hong Kong, Macau, Hainan, Thailand, and even into places like Japan as the Chinese start to travel again. The Chinese tourists are likely to be back in Europe in Q4, probably back into the US in Q1. Again, this is going to be positive for the space overall.
Jon, well, let's wrap it up by pinning you down. What are your top picks in European luxury?
Yeah, we really like actually the top quality names given the environment. Hermes is amongst our preferred picks, as is LVMH, Moncler. These are the guys that have been banging out great numbers, come what may. We're a bit more sort of pessimistic on some of those names, maybe reliant on a new designer to turn things around. This is probably not the best environment for that. And I also have a quick sneak peek at the hard luxury segment. I'm a big fan of Richemont. I think that's come back a long way. Swatch Group, bit of a stalking horse there, very, very cheap. Watches of Switzerland as well, stock really bashed up over the summer. And so there's some interesting opportunities. When you're getting down to sort of 10 times PE for some of these luxury or retail names, they start to look very attractive. As I say, strong balance sheets, net cash, commitment to pay dividends come what may. There are some very interesting sort of cheap luxury stocks there, but otherwise the quality is what we favor. As I say, Hermes, LVMH, and the likes of Moncler.